I'll drink it in the pillow. I'll drink a goldfish head and knocking down Samsons, knocking down red stripe. Anything from my town to look at the lines. There's a beautiful beach on a sunny day makes everybody feel alright. It's not because drinking on the shore as the rising tide. The rains out, as the rains out, as to the birthdays gone by. There's a beautiful beach on a sunny day we call living life. Sip on a land shark, I'll sip on a Korean, on a bottle of Balash, a crack up a locally. Throw back in Amsterdam, I'll throw back a mango breeze. Yeah, partaking would be made the main dance to please. Each of the sunny day makes everybody feel all. It's not because drinking on the sugar is the right time. The rains out, as the rains out, as to the days going by. There's a bit on the beach on sunny days we call. Sunshine straight to your soul. There's a beer on the beach on a sunny day makes everybody feel alright. Drink it on the shore as the rising tide. Yeah, beer beach on a sunny day makes everybody feel alright. Drink it on the shore as the rising tide. To the blue days going by. Let it be on me, show us sunny days, what we call. Yeah, show us sunny days, what we call living the life. Yeah, show us sunny days, what we call living the life. They run 30 minutes late, singing Margaritaville and minding my own. Some foreign car driving with the road rage attitude. Pulled up beside me, talking on the cell phone. He started yelling at me like I did something wrong. He flipped me the bird, and then he was gone someday. Somewhere to be asking shit over the beach. Right there, always something. Circle the parking lot.
Right. Good morning, everybody. One second. Let me work out a couple of these bugs here. Right. Good morning, everybody. That's one bug I forgot to do. All right. Good afternoon, everybody. Welcome to the marketinstitution.com. and today we're going to do a little bit of education, kind of looking around, and I want to give everybody a little more information on what we look for as far as having a trade. Okay. The thing to remember about what we do here is it's a forward-looking technique, meaning we're anticipating turning points in the market ahead of time. Okay. Before we get started here, let me jump in. The information contained in this presentation should not be construed as a recommendation or an offer to buy or sell any security or financial instrument. Additionally, information contained in this presentation does not imply the suitability of any investment strategy. We are not licensed brokers. We're not investment advisors. All attendees of this presentation are encouraged to speak with a licensed representative of their choice regarding the appropriateness of investing, trading of any investment, or any trading strategy. We're using real-time market data. We'll be executing trades in a simulated account during our presentations. No offer on our part respective to sale or purchase of any security is intended or implied. Nothing contained in here should be construed as a recommendation to take a position in the market. The intent of this information is for instructional and educational purposes only. Any fair use of third-party trademarks or logos does not imply an affiliation or a sponsorship. All trading involves high risk, and past performance is not indicative of future results. We make no promises, guarantees, warranties, suggesting that any information shared will result in a profit and not in a loss. And you agree not to hold us legally or financially responsible for any reason. So as we start to get underway here, when we are trading in our live trading room, we are looking at very specific candle formations, a very specific location to anticipate where price will change direction in the future. Okay. So by doing this, we are looking at very specific group of candles. We're looking at pictures on the price chart, and yes, almost every single trader out there uses pictures. Okay. Everything that they are looking at helps create emotion, create that feeling of why they should be participating in the charts or participating in a trade. And we start to use and anticipate how traders will respond and react to that by anticipating where we will have any leftover unfilled orders. Okay. And that's the whole point of this is when we're looking at a trade opportunity. And for example, here on this, took a long trade on wheat. Okay, price broke out, came back in, and then we entered at the breakout, but we also had a profit target in place. Okay, and that profit target ended up in a what we call as a sell territory, and where we have a support area, sell territory, and we look for that leg base group of candles in that area. Okay, so we're anticipating that if and when price returns to that area, there's some potential leftover unfilled orders. Now, what you're seeing are some demonstrations of charts that we have taken in our live trading room, or some trades that we have taken in our live trading room as we're doing our pre-market routine and putting together our morning. Okay. So we may take short trades where we find large stacks of unfilled sell orders, and then we anticipate a profit target. And sometimes it even gets a little fun here. We just, excuse me, we hit the reverse button. Okay. I mean, price is dropping, and how many people are willing to buy as price is dropping right down into the demand zone? Now, so what's really happening behind the scenes here? Well, this picture is a picture of an accumulation of orders. A resistance area where price is being pushed down. All that simply means is there's more sell tickets than buy tickets. And then there's an accumulation of orders down below the resistance, okay, as buyers push price back up. When price leaves this area very quickly, okay, strong move, the chances are that most of the traders did not get all of their orders filled at this time. So what's the concept here? When we're looking to see who's on the other side of our trade, is it a bank or is it an institution or is it a novice trader? Okay. See, almost anybody that uses indicators and oscillators, you can imagine what the indicator and oscillator is doing as price is going straight down. In fact, an indicator or oscillator is always going to lag the market. Okay. Even volume lags. Okay. Now, why do I say that? Well, when you're charting on your chart, the transaction has to occur. It has to be documented. And then it has to be sent to a data provider. The data provider provides it on your chart. Some of it seems like it's instantaneous, but it's all past trades. So what we're doing looking at the left-hand side of the chart is understanding what that picture looks like, okay? And we're going to go through some exercises once I lay some groundwork here to help you visualize and forecast. Now, what we do at the Market Institution is we like to educate traders on why price changes direction. And that's by looking at picture perfect past trade setups. Okay. What we desire to create on the price chart. For example, and I'll do a quick example and then we'll jump right into the content. For example, and I started off with a Verizon chart today. When we're looking at this price chart right here, okay? When we look at it initially, we see that, wow, there's a place right there. I wish I could have bought, went long, right in this area and capitalize on that whole trade. Now, how many people would love that? Okay, buy low, sell high, and so on. Okay, so in order to get into that trade, you have to be pretty crafty. Okay, how do you anticipate that turning point ahead of time? Well, the information is over here on the left-hand side of the chart. There are some characteristics and pictures on the price chart where we have the picture of leftover unfilled orders. Here's another quick little example. And I'm going to get into the detail of all of this as well. Okay, so just hold on. You're kind of going, well, what does that mean? I get it. What you also find throughout this little presentation, when we talk about a desired trade, is a desired trade creates emotion. Okay. I wish I could have got into that. I mean, you can actually feel that. Oh man, if I bought Lair at $40 and sold at $44, even with 100 shares, I make $400. Okay. You feel that. It's emotional. So in order to forecast these turning points ahead of time, we have to use information over on the left-hand side of the chart. And that information is most often always present when price changes direction. Okay. And I'll say most always, because there are times when the market changes direction where it's creating a new fresh accumulation of orders and where it's just reacting off of leftover unfilled orders. Okay. So let's get a little further into our conversation here about a desired trade. Okay. So who's on the other side of our trades? If they're using indicators and oscillators, it's usually the nervous novice. Why? Because everything is on the price chart. Okay. It has to be there in order to create the indicator. Okay. In fact, if you look at every peak and valley, you'll notice that indicators like stochastics, MACDs, RSI, CCI, and Bollinger Bands, and all those type of things, Keltner channels, whatever you want to name as indicators or oscillators and stuff, the price has to be present before that indicator can be documented, okay? And very often on almost every single platform, it's based on a closed bar, not the open or high or the low of the bar, okay? So this is where a lot of robots or other type of program trading can get you into trouble, because most charting software doesn't use all four parts of a candle. It only uses one part, which is the close, okay? So that means that candle has to close. All those orders have to be processed and documented before the indicator can actually even adjust. What you all notice is that when price changes from down to up and up to down, okay, it takes about 5 to 7 bars before that indicator or oscillator will produce a buy signal or sell signal. So indicators and oscillators are always showing up late to the game. Now, the poised professional, they have orders. They get their orders from upstairs, which are the investment bankers. And their job is to process orders for the company in order to satisfy what the company's needs are. So the company calls the investment banker. The investment banker does the calculation of, if the company needs money or is making a deposit. Okay. They, at that point, will then send the order down to the floor traders. Floor traders start working with the market makers, and if there's a lack of orders, the specialists will step in and adjust price up or down in order to make an easy market. Okay. Now, what we are going to explore today, and this is going to sound a lot, it may sound new to you, okay, but we're going to use the pictures on the price chart in order to verify and validate what I'm sharing with you. When the floor traders are processing a large order for the companies, almost never do they get the whole order processed at one time. It's not like they can hit a market order and thousands of shares get filled right at that moment, because there's only a certain number of shares at each price point, okay? So if they hit a market order, they could end up sweeping the book, okay? So they have a fixed price range where they're transacting the orders for the investment banker, the guy upstairs who's working with the company, to get them their money. And this is how we start to keep an orderly market here, is by noticing who is on the other side of your trade, okay? Now, a couple of basic things here. And I'm going to say these are basic, but they really take a little more time to understand and how to put all the pieces together. Okay. The concept here is that the origin of any move in price, from going low to high or high to low, okay, this is where supply and demand are out of balance. Another way to say supply and demand is just say, this is where the sell tickets outnumbered the buy tickets, okay? Because sometimes supply and demand has this mystical thing about it, okay? All that really happened when price dropped at this point, gap down, is there were no more buyers, and price gapped down to find the buyers. If this is around the session open, it's because the floor trader came in, started stacking and organizing all of their trades, and then looked down at his desk and said, oh man, I'm missing some buyers or I'm missing some sellers. Okay. So when he looks, or she looks around and they can't find any orders to match, then they call the specialist over. And the specialist says, okay, where's your stack of buy orders? Well, they're down here. And the specialist will adjust price up or adjust price down in order to make a market. Okay. So some gaps are a result, well, most all gaps are a result of a great imbalance between buyers and sellers. Okay. If there's no buy tickets, price gaps down to find the buyers in order to make a market. If there's no sell tickets, price gaps up to find the sellers. And then once they're matching up, we get a market going back and forth, okay? This is where we find high probability trades with low risk and high reward. Now, two key mistakes that the novice traders make. They're always chasing after a trade. They buy after a rally in price and they sell after a big drop in price, okay? They sell at location where professionals, banks and institutions step into the market. So what this picture looks like as we start to gather information is understanding where the resistance level is. This is where sellers were pushing price down. The below that is where buyers were pushing price up. When we see that the sell tickets run out, price shoots up. Generally, these big, strong candles are a lack of sellers, and price rallies up until we find a group of sellers. Up here, there are more sell tickets. The picture down below here indicates that the banks and institutions still have orders there. We look at a very specific group of candles in order to find and verify, and it also helps us identify risk so that we can properly size our position accordingly, okay? So when price returns to that area, here's proof. There were more buy tickets still here, okay? Price rallied up to find the sellers again. So when we want to think like a bank or institution, okay? When price runs away from an area, the banks and institutions don't chase price. They just kind of cross their arms like this, okay? And they wait until price returns to that area. Now, many times there's algorithms and already preset orders still waiting there. When price comes back, they can still process those orders, okay? So some of the pictures that we're going to look at, okay? I'm gonna mainly focus on our leg base group of candles over here today in this presentation. But I want to show you how we arrive here and the location where to look, okay? Well, support and resistance are just where we have more buy tickets or more sell tickets. Buy tickets at support, sell tickets at resistance. Above a support, we have a lot of pressure pushing price down, where we have more sell orders than we have buy orders, okay? And below resistance, we have more of the buy orders than we have sell orders, okay? As we start to document the location of these, we always want to make sure that we take a quick look at the structure that creates. Sometimes these structures make double bottoms, they make double tops, they make head and shoulders pattern, okay? Reverse head and shoulders or regular head and shoulders. They can make cup and handles, they can make pennants, they can make flags, they can make wedges. All of that happens when the banks and institutions are processing orders in a small range in an area, okay? Now, part of this, knowing the structures, when we make lower highs or higher lows, the area we want to look at is a little closer to the breakout point, okay? Most of these, when we're making lower highs and higher lows, are part of a trend, and you have the trend on your side. Now, ultimately, we want to assess the risk, and that's by using a small group of candles, okay? We call the leg base, okay? So when we're reviewing this, making lower highs, we're going to look for that leg base group of candles closer to the breakout. Making higher highs, things are a little more risky. Breakout trades are not always the best trades to take when we're making higher highs or lower lows. Making a higher low or a lower high, we can see the area where we will look for the leg base group of candles, okay? Support occurs where a downtrend is expected to pause and concentration of demand or buy tickets. Each time price tests the support level, more and more buy tickets or buy orders are being filled. So over on the left-hand side, you may have a large stack of buy orders. Price comes down, test it once, test it twice and three times. That large stack of buy orders is getting smaller and smaller and smaller until there are not enough buy orders and price breaks out and breaks through that area. I know this sounds a little bit too basic, okay? And I'm not trying to downplay it, but the reality is all we're looking for is where banks and institutions have leftover orders in order to help us have a high probability trade. We're getting in and trading with the banks and institutions, not against them. Okay. Resistance occurs because occurs where an uptrend is expected to pause temporarily due to a concentration of supply. Each time price hits test a resistance level, more sell orders are being filled. When there are no more sell tickets at that price will go up. Okay. So again, just imagine the first test of resistance, we have a large stack of sell orders. Price tested again, that stack gets smaller. Test it again, gets smaller. When there are no more sell orders, price has to break through that level, go up to find the offsetting transaction. Okay. Now, sometimes these can be big runs and they can be smaller runs. Okay. And so on. We use support and resistance as part of our 5-step process as we go to identify the buy and sell territory. The buy territories and sell territories are where we have leftover, or where we have we have an accumulation of buy orders or sell orders. And at that area within that range is where we expect the leftover orders. When price returns to that area, we will see the banks and institutions initiate or finish up their processing that order. The buy and sell territories refer to the price action below the resistance or above the support. All of our leg-based group of candles, or a zone, where we identify those unfilled orders, must be in a buy or sell territory. Location is key. So throughout this little presentation of your desired trade, we're going to start training the eyes what to look for. We're going to use the left-hand side of the chart to verify that that information exists. Okay? By finding a trade we desire to have, big runs, long runs, okay, or shorts, long run up or down, okay? What was the picture on the left-hand side of the chart that's consistently there when there's a good trading opportunity? Now, as we get comfortable and you verify the information I'm sharing with you on the left-hand side of the chart, we can then start using it for the right-hand side of the chart to anticipate where price may change direction in the future. Okay. So this is pretty exciting. And if you've never looked at forward-looking techniques, you probably used a couple of the basic ones are support and resistance and trend lines, okay, where we anticipate price will change direction in the future by extending a trend line or a support or resistance level, okay? You may use Fibonacci techniques, okay? Fibonacci measurements to anticipate where price may change direction, where you have a 50%, 38 or 618% retracements, okay? Pullbacks into those areas, which are commonly seen, okay? So a forward-looking technique is anticipating where price will change on the right-hand side of the chart, okay? But in order to get a good understanding of this, you have to prove and verify the information for yourself. Now, we have a lot of details that we put together. Today, we're just going to take one of those details to get you started, okay? And in this industry, it is important to verify information, not just take it at face value, okay? There's a lot of things out there, and most of these successful traders have years of experience, thousands of hours in front of the charts when they're timing the market, and they see all these things. Not often do they do a great job of explaining it all, though. Okay. So at the market institution, I want to give you and introduce to you a picture on the price chart. Okay. Now, the picture comes in a lot of different shapes and sizes and variations. In order to get the detail, you're going to have to adjust that little microscope up or down by changing the time frame just a little bit left or right, okay, or higher or lower in time frame. It doesn't take much, okay, but your job is to verify this information. It will get you excited when you start to see that, oh my gosh, this leg base group of candles is present and price change direction, okay? So what does that mean? Well, we'll get into that. So let's start with something basic here. This is our leg base group of candles, okay? It's a very specific group of candles, and you will have to adjust the time frame up or down to get the exact picture. This exact picture of the leg base group of candles helps us identify a range in where we can assess risk on the trade before we even engage in it. The distance between the high pivot and the base candle, or the low pivot and the base candle, that's how we expose the risk on the trade. Now, that risk ties to your personal trading plan, not to mine. You may be willing to risk $100. I might be willing to risk 150. Somebody else wants to risk $300. It all depends on the individual trader based off of their personal trade plan. We highly recommend you always use stop loss orders to protect your trading account and not just leave an order out there on its own. Okay. So getting familiar with this. Leg base group of candles is a very specific group of candles where we are looking for our buy and sell opportunities. We look for this group of candles inside the buy territories and sell territories. And this is often where we find unfilled orders once price returns to this area. So let's break down some variations here. Basically, a leg candle is a candle where the body is greater than 50% of the range. That's it. Simple. We take the range of the candle from high to low. That's wick to wick, or tail to tail, shadow to shadow, whatever you want to call it. That whole range, if the body is greater than 50% of that whole range, we call this a leg candle, okay? The color of the candle doesn't matter when determining if it's a leg candle. If price gaps up or down, the gap is considered a leg candle. So if price gaps up, it's a leg candle that's green and to the upside. If price gaps down, it's a leg candle, red to the downside, okay? So just variations of different groups of candles. The range is from wick to wick. If the body is greater than 50% of the whole range, it's a leg candle. Now, a base candle, okay? A base candle is a candle where the body is less than 50% of the entire range. The candle or the color doesn't matter when determining if the candle is considered a base candle. Again, take the whole range, wick to wick. If the body inside is less than 50% of the whole range, it's a base candle. We use a combination. Leg in, a base candle. Leg out, followed by a base. The last base candle is important, okay? Colors matter. The leg in candle must be red. The leg out candle must be green in a buy zone, okay? Some variations of this. The leg in must be red, as we just said. Base candle can be any color, can be red or green, okay? And you can have 1 to 5 base candles between the leg in and leg out. No more, okay? You see how this is getting really specific, okay? Most often you're going to see 1 to 3 base candles, but you can go up to 5, no more than that. If it goes up, then you have to adjust the time frame just up or down a little bit to get the exact picture. Now, getting the exact picture does many things for your psychology as far as getting your trade plan, as far as executing on a trade and managing risk. It gets it very detailed. Okay. The leg out candle must be green, and this is for a buy zone. You can have 1 to 4 leg out candles. The base candle may be any color, the last base candle. The first base candle after the leg out concludes the sequence. Okay. So we might have some variations like a leg in, a base, a leg out, and a base. Another one, leg in, base, leg, and then the base. I mean, there are several different combinations of these, okay? But it's always red leg candle in, base candle, leg candles out, followed by the base. So specific that a computer can replicate it. And that's important for creating a trade plan where you plan to take an entry on the trade. The entry line is the first candle after the leg out. This is where we place our proximal line, or you can call it an entry line, where you're going to execute on the trade. The lower level is where we have the leg stop line, is where we have at the lowest point of the leg in, base, and leg out. So these 3 candles, the lowest point, that's where you're going to place your stop loss. The area in between becomes the risk on the trade. Now, at this point, you already understand the risk ahead of time before price returns here. You can size that position, 1 contract, 2 contract, 3 contracts, shares or lots or whatever, based on your personal trade plan and what you are willing to risk with that trade plan, okay? So the example here is I have a leg base group of candles. We had where the sellers were pushing price down and the buyers were pushing price up. We made a higher low before price broke out. This is our trade assessment. When we look over to the right side of the chart and wait, once price returns to that leg base group of candles, we see that it changes direction. See, this is the first part where I'm starting to train your eyes. And that's what we do here at the Market Institution, is we start training the eyes where to look for high probability, where low risk and high profit potential turning points in the market. The sell zone, okay? Leg in, base, leg out, base, okay? These have to be very specific. It takes about 50 to 100 times of identifying it, and then you'll start to see it. And you'll see some of the variations of these as well as you're changing time frame to get that exact picture, okay? The leg in for a sell zone must always be green, and the leg out must always be red. I can have 1 to 5 base candles between the leg in and the leg out. I can have 1 to 4 leg out candles. The first base candle after the leg out concludes the sequence. Variations, leg, base, leg out, base. Leg in, base, leg out, and a base, okay? Leg, base, leg, and then a base, okay? There's a lot of variations. But they're confined within a small set of criteria that we've just outlined, okay? The distal line where your stop loss line goes to the highest wick of the leg in, the base, and the leg out. The first base candle after the leg out is where you place your entry line or proximal line, okay? The area in between is your risk on the trade, okay? Now, as you are looking down in time frames, you may see some variations till you get to the leg base group of candles. You might see a 2 candle flip. a place where there's a wick over wick, a drop-based drop, or rally-based rally, okay? Now, when we're looking inside of a rally-based rally or a drop-based drop, if you keep adjusting the time frame down, you'll find your leg base, where you can identify the risk in that. Or inside of a wick over wick, you adjust the time frame down and you will get the details of drop-based drop, rally-based rally, and the leg base. So in these areas where the candles and the wicks and tails overlap, adjust the time frame down to find the leg base group of candles. Okay. So just as a review, sell zones, leg in must be green, leg out must be red. Leg base. A buy zone, leg in must be red, leg out must be green. Okay. Leg base. Okay. When we start training the eyes to see the picture on the price chart, then we know what to look at on the left-hand side of the chart so we can better anticipate what's going on the right-hand side. For example, as we started off this presentation, this presentation is about looking for that desired trade. Not one that's going to happen, but one that has already happened. Because there's a lot of information on the left-hand side of the chart that helps us anticipate where price will change direction in the future with a high degree of probability. And you'll find that chart patterns work for this, Fibonacci levels work. I mean, there's a variety of techniques that work, trend lines, support and resistance, and so on, to anticipate and validate a desired trade. The price was dropping very quickly. How many of you would like to be buying right at this area? In order to be able to buy looking forward, we have to look backwards or to the left-hand side of the chart and start looking for the accumulation of orders where the banks and institutions started buying. And then price left the area. They didn't chase it, they just waited. Okay? So we have our resistance, we have our structure, buy territory, and then we find that leg base. So all of this information on the left-hand side of the chart was present, and we got a desired trade. Okay? You have to start studying the left-hand side of the chart for trades that you want to have. What you focus on is what you create. What you think about is what you manifest. Most novice traders out there are thinking about how much they're going to lose on a trade, okay, or where they're going to stop out, okay? Here, we want to start to look over and say, I desire to take a long trade here, therefore I need to look over to the left-hand side of the chart and adjust the time frame up or down to get that right picture. Now, with many charting platforms, you can, and on this platform that I'm sharing with, we have a tool which called the Doji tool, okay? Now, the Doji tool basically is a modified tool that says, hey, when the body is less than 50% of the range, put a blue dot on it. If the body is greater than 50%, leave it alone. So every candle that has a blue dot is a base candle, okay? Now, the nice part about this is, the trade already worked. You're just looking for what evidence is over on the left-hand side of the chart that's present when this desired trade took place, okay? So this is the area, and being very specific, I need to leg in, base. Whoop, I got another leg candle to the downside, so that's not the right picture. So let's adjust it. It's from a 120-minute chart, let's go to 119. Whoop. Okay. So I adjusted it a minute. And it's important to get the right picture. Now, as you go, this is 19, excuse me, 119. There we go. Okay, now by adjusting that picture, 1 minute, we got a little closer. Let's go another minute, 118. Now, first off, all, there is no magic in a 118-minute chart, okay? It's just about adjusting the time frame up or down to get the exact picture that we're looking for. And right now, we still don't have it, okay? See, you have to be willing to do the work and verify the information that I'm exploiting. This is another picture. It's still not quite right. So let's go 100. $90. See, what I'm looking for is that group of candles to be very exact if I have an opportunity to execute on a trade. Sometimes this takes a little work in order to get the right picture, as I'm doing right now. And for 6-2, well, we just can't get rid of that one leg candle, can we? Getting close. Oh, there we go. Okay. Now let's check. We have a leg in candle. And when you first start this, put a vertical line on the leg in. And then put a vertical line on the leg out. In between the leg in and leg out, base candles only, and we can have 1 to 5. 1, 2, 3, 4. We had 4 here. First base candle after the leg out is where we place the proximal line, and our distal line goes at the lowest wick, tail, or shadow. This whole range becomes our leg base group of candle. So the conversation we want to have with ourselves now is understanding that this group of candles was present and price changed direction at a place we desired to make a trade. Okay. So let's come back out here. I'll do another one. We got Boeing. All right. I'm looking at this last move up on Boeing going from about 138 to 173. This is what I would desire to have a trade going long right in this range. So I need to look left. Let's put a horizontal line there. Go back as far as necessary. And see, the more we do this, place a vertical line on the leg in. Place a vertical line on the leg out or multiple legs out. So in between the leg in and leg out, we have base candles only. Okay. The first base candle after the leg out is where we place our proximal, the lowest wick, tail, or shadow, where we place the distal line. Okay. And let's go out to a little larger time frame here. So we come back to where we desired to take a trade. And we look over to the left, and this is where we had the leg base group of candles was present, price change direction. Okay. So as price is moving higher, and as we're going over to the closer to the right side of the chart, a sell order, I have a vertical line on the leg in, place another vertical line on the leg out. In between the leg in and leg out, we have base candles. place my distal and proximal line around the area, then we would be anticipating, I mean, as many times as you verify this, price changes direction. So price is rallying up into an area that had a strong move down. There's potential for leftover unfilled orders still in this range. Okay. So we can do this on any time frame. We do it on futures products intraday. Okay. So what do we have going on? I got my indexes. And as we're looking at S&P, okay, S&P is approaching a resistance area. Okay. We're still within our prep screen zone. NASDAQ all-time highs just going to the moon again. Unbelievable. Okay. In this case, the short traders are just making the market go higher and getting squeezed. The Dow, I think the Dow is the one that's I'm waiting for mostly. A couple other things to keep in mind as well when we're doing our live trading room. Early in the session, we called for the market to be going, or the Dow to be going lower. Okay. We have a prep screen zone on our chart. And as we go over to the left-hand side, we're looking at where the zone is located. Okay. In a buy territory after resistance. Okay. The prep screen zones are zones that are created during the regular trading hours, usually on increasing volume. Okay. Most of the zones in the overnight session are a little less strong. In other things that may impact this decision to take a trade short, taking a breakout down to the prep screen zone, is by looking at a larger time frame. On the daily chart that I have down here, we can see that we have 7 completed candles to the downside. Well, very often you will see that the candles trade in groups of 2s, 3s, 5s, rare for 8 candles, and extremely rare for 13. Now, you get 8 candles down in a row, very, very high probability that the 9th candle is going to be very big to the upside. Okay. It's rare that it happens. So this demand zone, along with where the 50 simple moving average is on the daily chart, okay, we have a zone, so we're using some additional information, including the leg base, to identify the risk on the trade. And on this risk, we have 83 points. So when you're looking at 83 points risk, if you enter at 44,083, you know, how many contracts can you have to stay within your trading plan? Maybe 1 micro, maybe 10 micros. You know, it's totally based on your trade plan. What are you going to risk on that trade? Okay. We had some good levels here on gold. Okay, gold is doing well. What else are we in? We have, oh, corn has done fantastic. Corn, we've kind of annotated a lot of things on this chart as far as taking a demand zone entry, managing our risk. Okay, but not only getting into the trade and managing our risk, but looking what's up and to the left. Now, a pocket of points is an area where we have light volume price drops and price easily goes through this area. Okay. This leg base is in the wrong location. It's not within a sell territory. Therefore, this area, we expect to pause. 87% of the time, you will see that price will move 1-to-1 away from a leg base. Okay, so if you don't want to take that 1-to-1 move back down, then this becomes a profit target. Okay, where we're anticipating price to change direction would be up in the sell territories or zones within the sell territory, okay? So let's come back and look at a couple more charts. I'm just going to randomly, if you guys have any charts you want us to look at, give me a ticker symbol and a time frame that I can start with, okay? Now, I'm not looking to forecast. I'm just looking to verify information on the chart. For example, we got Swiss franc, okay? And price went right up here, found some sell tickets and shot right back down, okay? So I'm going to look over here and adjust the time frame up, okay? This place where I have my arrow is where I desire to take a trade, okay? Now, I desire to take this trade short on the Swiss franc, and this is the Swiss franc futures contract. You'll find that this works. Oh my gosh. This weekend, I spent some time doing this on I started going back and looking at all the, the cryptocurrencies using daily charts and small time frames, and you'll be absolutely flabbergasted to see that the crypto markets are doing the same thing. They're getting more and more correlated to what we see on the price charts. XRP, SOL dropped right back into that demand area and shot out of that. Okay. So the crypto market is getting closer and closer to being correlated, almost like what we look for on the stocks futures type charting. Nice thing about crypto, though, is you can bring in a time element because it never stops trading. Okay. I'll save that for another class. To know where price is going is one thing, but to anticipate in time when it's going to happen, even more cool. Okay. All right. So in this area, we're looking for that leg base. I'm on a 240-minute chart. Let's try 180. The reason you're adjusting the time frame is to verify what I am sharing with you. Do not trust this information. Verify it yourself, okay? Find a place you desire to take a trade long, or find a place you desire to take a trade short, and then do the due diligence. Look left. You already know the trade worked. Now it's just time to find the right time frame to get that leg base, help you assess the risk on the trade. All right, there we go. Let's open that up. Start off, it takes about 100 times of doing this, and then you go, okay, I can see it at a glance. Okay. It doesn't happen in 3 or 4 times of doing this. Okay. Leg in, placing a vertical line. Okay. Place another vertical line on the legs out. Okay. In between the leg in and leg out, base candles only. In this one, leg, base, leg, and a base. Okay. Place your distal and proximal line around these areas. Extend them forward. And bam. Well, wait a minute. That was here days before the trade I wanted was here. This was my desired trade. I'd love to have a trade ready right there at the proximal line. Price goes up, ticks it, and then straight back down. If you desire to have trades like this, then what is on the left-hand side of the chart that was there to help it? Pretty cool. And let's look at this one since we have it up here. A desired long trade. Coming over to the left-hand side of the chart. Okay, we got a couple of areas. I'm going to go with this one at first. Place a vertical line on the leg in. We got 3 legs out, another base candle. Distal line and proximal line help us identify the area for risk on a trade. And then there's another one right over here at the origin of a strong move. So this would be the area. Now, just a little insight here. You notice that what these leg candles leaving your zone, these two are smaller than the leg candles leaving or inside the zone. Okay. In this scenario, the leg candle leaving is much bigger than the leg candle in the zone. Now, a couple little odds enhancers on this. This upper zone, price will go deeper into it, and the characteristic is the leg candle leaving is bigger than the one in the zone. Price will only use a proximal line entry or not go too deep into this zone because the leg candles leaving are smaller, okay? So the result of this, when we go back over to the left-hand side of the chart and we look at our desired trade, let's bring that back up. Is again, we're using information on the left-hand side of the chart. It was here back in July, and it took all the way to the end of November before price returned to that area. But again, this information was here, the leg base, at a place you desired to make a trade. FX markets, same thing. Are you willing to adjust the time frame up or down to get the right picture? Okay. It's just a little work, and they don't charge extra for you changing time frames on your chart. All right, I got another desired trade right here. Okay, this is a place I want to take a trade short. This is the Aussie USD and FX product. Okay. This is the area I need to look in for a leg base. I'm going to drop down to small time frame. This is a place we desire to take a trade. Now we're coming over to the left. Leg in, base, leg out, and another base. See, they come in different shapes and sizes, but the candles are always the same. Leg base, desired trade. Okay. What we're looking for are places where there are unfilled orders. Now, I can tell you for a fact, I have tried to get in short, like right up here, and push that price down with my 1 or 2 contracts. Doesn't happen. So somebody with a lot more money had more sell tickets up here. Okay. We need to be looking left for these orders. Okay. Now these work on any product and including crypto. Okay. As we look at, wow, we had Goldman Sachs this morning. Okay. Prices gap down. Why did price stop right here? Well, let's look right in here, dropping down, smaller time frame. Up, too many base candles. Okay, let's go up. Let's go 30-minute. Oh, a nice clean picture. Leg, base, leg, base. Now, all we did was adjust the time frame to get the exact picture of the leg, base group candles. This picture was here and price stopped going down. I mean, how many times have you taken a trade on a stock, on a futures contract, on anything, and price just stopped going down and reversed? Okay. Need to spend some time on the left-hand side of the chart. Now, today, all I've done is introduce you to looking for places on the price chart where you desire to make a trade. We'll do a series of these little lessons to help you see the picture, okay? But first, we have to figure out what it is you want to create when you're looking at these charts. What do you want to create? Let's just do this on a futures product, okay? How about the S&P futures? I'm looking at a 30-minute chart on the S&P futures. Okay. It's a continuous unadjusted chart. Okay. Using the 107XN, which means the gap occurred. This is a rollover gap. Okay. And a rollover gap occurs because of carry-in, holding fees, carry-in charges, some other expenses. How's that? Okay. So when I'm looking at a price chart and I want to anticipate where do I have another opportunity to go long? Well, we always go not to chase price, but to wait for price to return, pull back or buy on the dip. So you take current price and you start going down and left and you start looking at areas which have that leg base group of candles. See what we've done with the leg base group of candles in just a few examples, okay, is that we've identified that when the leg base is there, price changed direction, okay? How about this move up right here? Well, we got to go over to the left. May have to adjust the time frame up or down. Let's look right in that range. Let's go 31 minute. See, why are people so afraid to change the time frame 1 minute? Okay. Well, a lot of charting platforms don't have the capacity to do that. Okay. The important thing is when you have to verify something, it's never about the time frame that you're trading. It's about the picture, the slopes, the angles that attracts you to it. Okay. Now I'm still looking in this area for a leg base group of candle. Okay. 40, let's go out to 60. And I'm changing the time frame up or down to get that exact picture. Now, on a 60-minute time frame, I have a leg base. Price did change direction. Okay. Another little piece of information. With this leg base group of candles, you can see that the leg candle leaving is bigger than the leg candles in the zone, even if it's just a little bit. That means this area can be used twice. First one, a proximal line entry. Second one, price goes deeper into the zone. But in front of this big move to the upside, and I know a lot of people blew their accounts on this move up, trying to pick every top. Might have been some of you, okay? That group of candles was present, price changed direction, okay? Let's drop this down to like a 5-minute chart on the S&P. Any time frame, okay? Here was a place where we had a strong move up, okay? A desired trade to go long the S&P 500 right in that range. Now we need to look left. find the leg base group of candles. See, it's close. We got leg. So we go down to 4 minute. Oh, look at that. By adjusting it 1 minute, we can get that leg base. If you're new to this, it'll take you about 100 times of identifying that leg base and seeing a trade you desire to take. Okay. This is a trade. This trade we desire to take. This was over on the left-hand side of the chart. Okay. Now, as we dig in further and in different lessons, I don't want to take too much time out of your trading day. Okay. But as we do more lessons, you will start to see that there's additional pieces of information over on the left-hand side of the chart that helps you choose which leg base is going to be a higher potential outcome of a trade. Okay, high profit, low risk, okay, and high probability. So let's wrap this up here. One of the things that we put out each morning is our daily overview. We have levels where we have our S&P prep screen zones posted, NASDAQ, S&P, Russell, and the Dow. We always check our news so we can see what the public is thinking. Okay, and we have economic reports, Fed speakers. We know that the time frames when these announcements or Fed start speaking, the market often gets pretty volatile. The reaction to the report is generally price shooting up to find sellers or shooting down to find the buyers. Now that you have a general idea of what that looks like on the price chart, you would start to monitor those ahead of time. We talk about some pre-market tips, okay? And some of these are posted on our Twitter or X and in our social media, okay? But not all the detail that we have. We talk about crude oil and natural gas report. This is from one of our students. And Miss Chris has been doing this for 123 weeks. The average move off of the crude oil report has been about 0.062, okay? Which is the lowest for the last 4 weeks. And she uses the API forecast, okay? Now, the API report comes out before the EIA report. The EIA report is what everybody's been waiting for, okay? At 10:30 Eastern on Wednesday, and for natural gas on Thursday, okay? So this is all related to last week's numbers, not this week's numbers. So, and then we produce about 16 potential trade setups where we have price coming back to find buyers, or we're looking for the breakout point for a trade opportunity. One of the best ways you can use all of our candidates is looking at them and say, well, how many of them are zone entries where banks and institutions are involved, and how many are breakout trades where the public is involved, okay? Knowing who you're trading with can put you on the right side of many trades, okay? This was another example from the live trading room. We have a lot of things that we measure. And when price between, what we know for sure is between 8 a.m. and 11 a.m. Eastern, banks and institutions complete most of their order flow. We've also documented that when price arrives at a demand zone or supply zone, it must arrive on time. If it comes in about 4 or 5 minutes early, it generally will bounce off of the line, but then continue on through it. So this was a really great example of demonstrating that in the live markets. And one of the best ways to demonstrate to traders is by taking trades while they're happening, okay? While they're manifesting, okay? Anticipating those turning points and then getting prepped and ready. See, if you look at the picture, we have small zones inside of larger zones. They're all fractal, but basically the same pattern, okay? This was a great example. Our price just, look how fast price dropped into that. When the stronger the arrival back to that zone, the more potential leftover orders are there. Okay. So we're able to put that trade out there ahead of time. Our team puts together a little summary. We go over these each week as part of our support, summarizing what the pre-market information was telling us, and then also what happened just after the open. Okay. See, the more that you are aware of these things, the more that you see them work right in front of you, the easier it is to participate and trade with them. So I want to thank everybody. We do have a final sale of the year before all of our prices increase in 2025. Okay. If you're interested, if you want to see what we do have another, we have every Friday we do a live stream demonstrating what we're doing in our live trading room. We're not out here to gouge everybody in prices. We're here to give everybody a really good deal. But everything else has gone up in price. We've held our prices down. Reason for that is we want you to recover your tuition within 1 or 2 trades. Okay. And if you just need to join us to do that, fantastic. Okay. But education shouldn't be outrageously expensive for this. You can easily recover your tuition costs in just a few trades. Okay. Check us out Friday on our live stream. Check us out and let us know what you think. Have a great day, everybody, and trade safe. Okay. Thank you, team.